Welcome to the program You Can Beat the Stock Market. Here I show you how you can beat the stock market. I am Francisco and today we're going to talk about investing in blue chip stocks. Is it really the bulletproof strategy many believe it to be? Is there any mid cap or small cap that outperform blue chip stocks? Blue chips are usually large companies with substantial market value. Blue chip stocks are known for their steady and reliable earnings. They often pay dividends to shareholders, reflecting their strong and consistent financial performance. These companies have a long history of sound financial performance and are often leaders in their respective industries. Blue chip stocks can vary in their characteristics, and this variation leads to different types. Blue chip stocks span a wide range of industries, from technology and consumer goods to finance and healthcare. Growth blue chip stocks are companies known for their potential to grow faster than the overall market, often reinvesting earnings into further expansion. Value blue chip stocks are typically undervalued in the market but have strong fundamentals, making them attractive for their potential for long-term returns. Some blue chips regularly distribute profits to shareholders as dividends, while others may reinvest profits back into the company. Blue chip stocks can be found in both domestic and international markets, offering both investment opportunities. Blue chip stocks are considered more stable with lower risk due to their established business models and consistent performance. Non-blue chip stocks can include smaller, less established companies that might offer higher potential returns but come with greater risk and volatility. Blue chip stocks typically have slower, more steady growth. Non-blue chip stocks might offer rapid growth potential, appealing to investors looking for higher returns and willing to accept more risk. Blue chip stocks generally have market capitalizations reflecting their size and stability. Non-blue chip stocks often have smaller market caps and can include mid-cap and small-cap stocks. Blue chip stocks are suitable for investors seeking stable investments, often as part of a long-term strategy. Non-blue chip stocks may be more appropriate for investors with a higher risk tolerance and a focus on short-term gains. Blue chip stocks are renowned for their reliability, stable earnings, and dividends, making them a cornerstone for conservative investment strategies. In contrast, non-blue chip stocks can offer higher growth potential, but typically come with increased risk and volatility. Even blue chip stocks, known for their stability and solid performance, are not immune to the effects of market conditions. Various factors can influence these stocks, including economic changes, industry-specific issues, and broader market trends. Interest rate changes by central banks, like the Federal Reserve in the US, can significantly influence blue-chip stocks. When rates rise, borrowing costs increase, potentially reducing corporate profits. Conversely, lower interest rates can stimulate economic growth, benefiting these companies. For example, higher interest rates can boost the profitability of banks, such as JP Morgan Chase, by widening the margin between what they pay on deposits and earn from loans. Companies like Home Depot might see a decrease in sales during high interest periods as mortgage rates rise, slowing down the housing market. Automakers like General Motors could experience decreased sales during high interest periods as higher financing costs deter consumers from purchasing vehicles. During economic downturns or recessions, even blue chip companies can experience decreased earnings as consumer spending and business investment decline. Conversely, during economic upswings, these companies often perform well due to the increased spending and investment. Companies like Procter and Gamble may see a decline in high-end product sales during recessions, but maintain steady sales in essential goods. High-end retailers such as Tiffany and Company often experience reduced sales during economic downturns as consumers cut back on luxury spending. Tech giants like Apple might face reduced consumer spending on non-essential electronics during economic downturns. Inflation and currency fluctuation. High inflation can erode purchasing power and increase operational costs for companies. Additionally, currency fluctuations can impact multinational blue-chip companies, affecting their overseas earnings when converted back to their home currency. Companies like Coca-Cola, which operates globally, can be affected by currency devaluation in foreign markets, impacting their converted earnings. Firms like Walmart, which import many goods, may face increased costs due to a weaker domestic currency, affecting profit margins. Export-oriented businesses like Boeing benefit from a weaker dollar as its products become more competitive in international markets. Rapid advancements in technology can disrupt traditional industries in which many blue-chip companies operate. For instance, the rise of digital streaming services like Netflix has impacted traditional media and entertainment blue chips such as Comcast. Companies like Walmart had to adapt rapidly to e-commerce trends to compete with online retailers like Amazon. Traditional automakers like Ford are investing in electric vehicle technology to compete with companies like Tesla. Regulatory changes. New regulations or changes in government policies can affect certain sectors. Energy giants like ExxonMobil face challenges with environmental regulations aiming to reduce carbon emissions. Pharmaceutical companies such as Pfizer often have to navigate complex healthcare regulations, which can impact drug pricing and market access. Banks like Goldman Sachs must comply with various financial regulations, which can increase compliance costs and affect operation flexibility. Competitive pressures, increased competition, either from new entrants or existing competitors, can challenge the market position of blue-chip companies, affecting their stock performance. For instance, AT&T and Verizon continually compete in a high competitive market with rising players like T-Mobile. Apple faces significant competition in the smartphone market from companies like Samsung and Huawei. Amazon competes with a growing number of online retailers, and traditional retailers increasing their online presence. Investor sentiment, often driven by broader market trends or global events like geopolitical tensions, can impact stock prices. Even blue chip stocks can see their prices fluctuate based on overall market sentiment. Companies like Microsoft and Apple can experience stock price fluctuations based on general tech sector sentiment. During health crises, companies like Johnson and Johnson may see stock fluctuations based on the overall market perception of healthcare needs. Companies like Chevron might see an increase in stock prices as market sentiment improves during economic recoveries. Events such as geopolitical conflicts, pandemics, or international trade disputes can create uncertainty in the market, leading to volatility in stock prices, including those of blue-chip companies. During COVID-19, companies like Pfizer and Moderna became focal points due to vaccine development. Companies with significant operations in affected regions, like Apple in China, can see stock impacts due to trade tensions or conflicts. Multinationals like McDonald's can be affected by global economic downturn fears, impacting their global operations. At times, market speculation and the trends driven by institutional investors can lead to significant fluctuations in the stock market, impacting all stocks, including blue chips. Stocks like IBM can be affected by short-selling campaigns based on market speculation. Companies like Disney can experience stock volatility due to merger and acquisition rumors. Firms like General Electric may see stock fluctuations based on whether they meet, exceed, or miss market earnings expectations. While blue chip stocks are generally considered safe investments due to their established business models and historical performance, they are not completely insulated from the various factors that impact the stock market. Economic cycles, industry-specific challenges, and broader market trends can all influence the performance of even the most stable blue-chip stocks. Blue-chip stocks, despite their reputation for stability and reliability, are not immune to underperformance or significant issues. Here are some real-world examples where blue-chip stocks have faced challenges, including during financial crises and due to company-specific scandals. General Electric, once considered a paragon of American industry and a staple in the Dow Jones Industrial Average, GE faced significant struggles in the late 2010s. GE suffered from a combination of factors including heavy debt loads, acquisitions, and a failure to adapt to changing market conditions. Its power and oil-gas businesses were particularly hit hard. The company's stock plummeted, and it was eventually removed from the Dow Jones Industrial Average in 2018, a symbol of its reduced stature. Wells Fargo, one of the largest banks in the United States, became embroiled in a major scandal. In 2016, it was revealed that bank employees had created millions of fake accounts to meet sales targets, leading to a massive scandal that tarnished the bank's reputation. This scandal led to billions in fines, a damaged brand, and a significant drop in its stock price. It also led to resignation of top executives and a thorough overhaul of the bank's practices. Boeing, a leading aerospace company, faced a major crisis with its 737 MAX aircraft. Two fatal crashes involving the 737 MAX in 2018 and 2019 raised serious concerns about their aircraft's safety and Boeing's oversight. Investigations revealed significant issues in the plane's design and approval process. Boeing's stock took a significant hit, and the 737 MAX was grounded worldwide, leading to billions in lost revenue and compensation claims, along with damage to its reputation. British Petroleum, one of the world's largest oil and gas companies, faced a severe crisis in 2010. The Deepwater Horizon oil spill, one of the worst environmental disasters in history, occurred at a BP offshore drilling rig. It resulted in a massive oil spill in the Gulf of Mexico that led to a steep decline in BP's stock value, massive cleanup costs, legal liabilities, and a public relations crisis that tarnished the company's image for years. Volkswagen, a prominent automobile manufacturer, was involved in a major emissions scandal. In 2015, it was revealed that Volkswagen had been using software in its diesel vehicles to manipulate emissions tests, falsely showing lower emission levels. This scandal, known as Dieselgate, led to a significant drop in Volkswagen's stock price, billions in fines and recall costs, and major damage to its reputation. Nokia, once a dominant player in the mobile phone industry, experienced a dramatic decline. Nokia failed to adapt to the smartphone revolution led by Apple and Android devices, sticking too long with its Symbian platform and being slow to innovate. Nokia's stock plummeted as its market share eroded rapidly. The company eventually sold its mobile phone businesses to Microsoft. Eastman Kodak, a giant in the photography industry, faced a steep decline. Kodak failed to adapt effectively to the digital photography revolution, despite having invented a core technology used in digital cameras. Kodak's stock value dropped significantly as it lost market relevance. The company eventually filed for bankruptcy in 2012. These examples illustrate that even blue-chip stocks, traditionally seen as safe and stable investments, can face significant challenges and underperform due to various factors like industry changes, management missteps, and external crises. It underscores the importance of diversification and continuous monitoring in investment strategies. Think blue chip stocks are your safest bet? Think again. Uncover the hidden secrets and the limitations that could impact your wealth. Watch these before you invest another dollar. Blue chip stocks typically represent established companies with stable earnings. While this can mean less volatility, it often also means slower growth compared to emerging companies or growth stocks. Investors seeking high growth potential, especially over short time frames, might find blue chip stocks less attractive. Because of their reputation for stability and reliability, blue chip stocks can sometimes become overvalued as many investors flock to them, especially in times of economic uncertainty. This overvaluation can limit future returns and increase the risk of a price correction. Large, established companies can sometimes be less agile and slower to innovate compared to smaller, more dynamic firms. In rapidly changing industries, this can put blue-chip companies at a disadvantage, potentially leading to underperformance. Many blue-chip companies pay regular dividends, which can be attractive for income-seeking investors. However, for those more interested in capital appreciation, the emphasis on dividends can be less appealing, as it might mean that less of the company's profits are being reinvested into growth opportunities. Blue chip stocks are often concentrated in certain sectors of the economy. Investors seeking a diversified portfolio might find that an over-reliance on blue chip stocks can lead to sector concentration, increasing the risk if that particular sector underperforms. Blue chip stocks, while generally stable, are still subject to broader market and economic dynamics. In times of economic downturn, even blue chip stocks can experience significant declines. Larger companies can sometimes be bureaucratic and slow to respond to market changes, which can impact their ability to capitalize on new opportunities or pivot in response to challenges. Many blue-chip companies have extensive global operations, which can expose them to geopolitical risks, currency fluctuations, and global economic trends that might not affect smaller, more domestically focused companies. The rise of disruptive technologies and new business models can challenge even the most established companies. For example, the rise of e-commerce has posed significant challenges to traditional brick-and-mortar retailers. Sometimes the size and established nature of blue-chip companies can lead to complacency and corporate governance issues, as seen in various corporate scandals over the years. While blue-chip stocks can be a cornerstone of a well-balanced portfolio, especially for risk-averse investors seeking stability and regular dividends, they are not without their limitations and risks. As with any investment strategy, diversification and a clear understanding of individual financial goals and risk tolerance are key. Investing in non-blue chip stocks often generates a range of concerns or objections from investors, largely due to their perceived higher risk compared to their blue chip counterparts. A common objection to investing in non-blue chip stocks is their higher risk and volatility. These stocks, often representing smaller or less established companies, can be more susceptible to market fluctuations and business uncertainties. Investors can manage risk by diversifying their portfolio not just across different stocks, but also across sectors and geographic regions. You may diversify across different stocks. You may include a mix of technology startups, renewable energy companies, and biotech firms in your portfolio. balancing out the risk across different industries. You may diversify across sectors. Your portfolio could include a combination of healthcare, consumer goods, real estate, and financial services stocks, ensuring that a downturn in one sector doesn't disproportionately impact your entire investment. You may diversify across geographic regions. The portfolio might contain stocks from companies based in North America, Europe, Asia, and emerging markets, reducing the risk associated with anyone's region economic or political instability. Conducting thorough research and due diligence can help identify non-blue chip stocks with solid fundamentals and growth potential. You can analyze financial health and fundamentals. You can evaluate a tech startup's financial statements, looking at their revenue growth, debt levels, and cash flow to assess financial health. You can also assess the management team and business model. For a biotech firm, researching the experience and track record of the management team, as well as the viability and innovation of their business model, would be crucial. For a renewable energy company, investors would study industry trends like regulatory environments and the company's position compared to its competitors to gauge its growth potential. Adopting a long-term investment perspective can mitigate the impact of short-term volatility. You may invest in emerging technologies with future potential. You may choose a company specializing in artificial intelligence or electric vehicles, recognizing that while the current market might be volatile, the long-term potential is significant. You may also stay invested through market cycles, holding onto shares in a healthcare startup through various market cycles, understanding that healthcare innovation takes time to materialize into profitable returns. You may regularly review and hold investments despite short-term fluctuations. An investor in a small e-commerce company may decide not to sell off shares during a short-term market downturn, believing in the company's long-term strategy and growth potential in the online retail sector. Each of these strategies illustrates a different approach to managing the unique challenges and opportunities associated with investing in non-blue chip stocks, emphasizing the importance of a balanced, informed, and forward-looking investment strategy. Another objection is the lack of information and transparency. Non-blue chip companies often do not receive the same level of analysis and coverage as larger companies, leading to concerns about a lack of information and transparency, which can make informed investment decisions more challenging. Utilize various sources for independent research. This can include industry reports, financial news, and analysis from multiple financial advisors or platforms. An investor interested in renewable energy stocks might read industry reports from energy sector analysts to understand market trends, key players, and future growth areas. Financial news and analysis. Regulatory following financial news sources like Bloomberg or the Wall Street Journal for updates on market conditions, and using platforms like Seeking Alpha for in-depth analysis and opinions on specific non-blue chip stocks. Utilizing investments platforms like Morningstar and Dividend.com for comprehensive stock analysis to get varied perspectives on potential non-blue chip investments in sectors like technology or healthcare. You may also start with smaller investments in non-blue chip stocks to test the waters while gradually building knowledge and confidence. An investor might start by allocating a small percentage of their portfolio to a promising but relatively untested biotech firm, planning to increase the investment as the company shows signs of growth and stability. Setting up a plan to invest small, regular amounts in a portfolio of startup companies, allowing for gradual exposure to these higher risk investments over time. Initially investing a modest sum in a few carefully selected companies from emerging markets, using it as a learning experience to understand the dynamics of these markets before committing more significant funds. Attending seminars or webinars where industry experts discuss trends and opportunities in sectors like artificial intelligence, green energy, or biotechnology, and using this information to inform investment decisions. Join online forums where investors share insights and experiences about investing in non-blue chip stocks and leveraging these networks to get recommendations for financial advisors with expertise in these types of investments. Each of these approaches offers a way to mitigate the risks and maximize the potential benefits of investing in non-blue chip stocks, whether through thorough research, cautious financial commitment, or seeking professional guidance. The third objection is the limited track record and proven stability. Non-blue chip stocks typically have a limited track record compared to the established blue chip companies, leading to concerns about their stability and long-term viability. Many non-blue chip stocks represent companies in innovative fields or those poised for expansion, offering potentially higher returns. Here is what you can do to achieve the potentially higher returns. Invest in a startup specializing in blockchain technology or artificial intelligence, recognizing their potential to disrupt traditional industries and create new markets. Allocate funds to a biotech firm that is in the advanced stages of developing a groundbreaking medical treatment or drug, which could revolutionize healthcare and offer substantial returns upon successful market entry. Invest in a company focused on solar energy or battery technology, sectors expected to grow significantly due to the global shift towards sustainable energy solutions. Combine stable blue-chip stocks with a selection of non-blue chip stocks from high-growth sectors like fintech or renewable energy to balance potential risks and rewards. Include non-blue chip stocks from different geographic regions, such as emerging markets in Asia or Africa, to spread risk and tap into diverse economic growth drivers. Create a portfolio that includes a mix of industries such as healthcare, technology, consumer goods, and manufacturing, which includes non-blue chip companies to hedge against sector-specific downturns. Look for companies with strong business models, good management teams, and clear growth strategies, even if they have shorter track records. Identify and invest in a company that has developed a unique business model or product, such as a new e-commerce platform or a revolutionary software as a service provider, even if it's relatively new to the market. Choose companies led by experienced and successful management teams, which can be a strong indicator of a company's potential for success even if the company itself has a limited track record. Look for non-blue chip companies that, despite their size, show strong financial fundamentals and sustainable growth strategies and a track record, even if short, of meeting and exceeding their strategic goals. These examples illustrate how, by focusing on growth potential, leveraging the benefits of diversification, and being selective in their investment choices, investors can effectively incorporate non-blue chip stocks into their portfolios to potentially enhance returns while managing risk. While concerns about investing in non-blue chip stocks are valid, they can be mitigated with careful research, diversification, and a well-thought-out investment strategy. Balancing these investments with more stable options can create a well-rounded portfolio that capitalizes on both stability and growth potential. Investing in non-blue chip stocks that have a history of outperforming the S&P 500 are a good choice because they have proven to be a better investment than the S&P for many years. Let's see 3 mid-cap and 3 small-cap stocks that beat the S&P 500. I analyzed the price change of all of them in relation to the S&P 500 in the last 5 years from December 7th, 2018 to December 8th, 2023. While the price of the S&P 500 increased only 78.8% in this period, these stocks increased 4 times up to 18 times as much as the S&P 500. The first mid-cap is Comfort Systems USA Inc. It belongs to the engineering and construction industry and the industrial sector. Its share price increased 304.1%. That's 4 times as much as the S&P 500. Comfort Systems USA Inc. provides comprehensive mechanical contracting services, including heating, ventilation, and air conditioning, or HVAC, plumbing, piping and controls, construction, and other electrical components. Projects are mainly for commercial, industrial, and institutional buildings and tend to be geared toward HVAC. Revenue is roughly split between installation services for newly constructed facilities and maintenance services for existing buildings. The company installs and repairs products and systems throughout the United States. It operates in 2 segments: mechanical services and electrical services. The majority is from the mechanical services segment. The second mid-cap is Axcelis Technologies Inc. It belongs to the semiconductor equipment and materials industry and the technology sector. Its share price increased 545.1%. That's 7 times as much as the S&P 500. Axcelis Technologies Inc. designs, manufactures, and services ion implantation and other processing equipment used in the fabrication of semiconductor chips. In addition to equipment, the company provides aftermarket lifecycle products and services, including used tools, spare parts, equipment upgrades, maintenance services, and consumer training. Geographically, the group has a business presence in North America, Asia Pacific, and Europe, of which key revenue is derived from the Asia Pacific. The third mid-cap is Elf Beauty Inc. It belongs to the household and personal products industry and the consumer defensive sector. Its share price increased 1,035.3%. That's 14 times as much as the S&P 500. Elf Beauty Inc. is a cosmetic company based in the United States. The company offers cosmetic accessories for women, which include eyeliner, mascara, false eyelashes, lipstick, the foundation for the face, moisturizer, cleanser, and other tools through its stores and e-commerce channels. The products that the company sells are marketed under the Elf Cosmetics, W3LL People, and Keys Soul Care brands. It carries out the sales within the US and internationally, out of which maximum revenue is generated from the US. And the first small cap is NAPCO Security Technologies Inc. It belongs to the security and protection services industry and the industrial sector. Its share price increased 295.4%. That's 4 times as much as the S&P 500. NAPCO Security Technologies Inc. manufactures security products encompassing access control systems, door locking products, intrusion and fire alarm systems, and video surveillance products. Its products are used for various applications, which includes alarm systems like automatic communicators, combination control panels, digital communicators, and digital keypad systems, fire alarm control panel, and area detectors mainly used for commercial, residential, institutional, industrial, and governmental uses. The second small cap is Tecnoglass Inc. It belongs to the building materials industry and the basic materials sector. Its share price increased 338.5%. That's 4 times as much as the S&P 500. Technology Inc. designs, manufactures, distributes and markets architectural glass and windows. The company's products portfolio include tempered, laminated, insulating and solar control low E glass. Its products are installed at hotels, residential buildings, commercial and corporate centers, airports and hospitals as floating facades, curtain walls, windows, doors, handrails, interiors and dividers. Its majority of revenue is derived from the sale and installation of architectural glass and windows in the United States. The third small cap is Hammond Power Solutions Inc. It belongs to the electrical equipment and parts industry and the industrial sector. Its share price increased 1,332.4%. That's 18 times as much as the S&P 500. Hammond Power Solutions Inc. is engaged in designing and manufacturing of custom electrical magnetics, cast resin, custom liquid-filled distribution, and power transformers and standard electrical transformers serving the electrical and electronic industries. The company has manufacturing plants in Canada, the United States, Mexico, and India, in which derives majority revenue in the United States and Mexico. These examples indicate that non-blue chip stocks can present significant growth opportunities, potentially outperforming traditional blue chip stocks in certain scenarios. However, it's essential to consider that such investments also come with higher risks, and thorough research and risk assessment are crucial before making investment decisions. And if you want to learn how to beat the stock market so you can retire earlier or just achieve financial goals faster, like buying a home, funding education, buying a Ferrari, or whatever you might choose, hit the like and subscribe buttons and turn on notifications. Until next time, and happy stock investing!